Understanding the current mortgage rates. Hi, I'm Jesse Johnson, Greater Vancouver Realtor and mortgage broker since 2006.
And I'm Azim Virani, longtime real estate investor and also Metro Vancouver Realtor.
In this episode of Own Your Life, we plan to cover the following topics: understanding the current mortgage rates, October's sales data, buying today versus buying 6 months ago, and the new foreign buyer ban.
We bring you this monthly podcast to keep you informed and so you can stay on top of all the latest trends and really get insight into what we're seeing out there in the market. Now, if you're looking to buy or sell property, whether you're just wanting to get your feet wet with your first property, whether you're a savvy real estate investor, or you're just looking to get an evaluation on your current home, definitely reach out to us. Our contact information is in the description below. And be sure to hit the like and subscribe button so you can always stay up to date with our podcasts. Now, there's some benefits with working with experienced realtors like myself and Jesse, not the least of which is all of the information we have at our fingertips, the experience we have with renovations and flips, and of course on the financing side. And that's what we're going to focus on a lot today. We're going to hit up Jesse's longtime experience as a mortgage broker so that we can all navigate the current changing market, the ever-increasing interest rates. So Jesse, really quickly, what kind of mortgage rates could you get for your clients today?
Great question, my friend. So to be clear, we're recording this on the weekend, so I can only go by information provided on the last business day. At that time, we were still able to obtain prime minus 1%, which would be 4.95, as well as a fixed rate of 5.29%.
So that's a fixed rate with a 5-year term?
No, good question though. So yes, rates are traditionally provided in a 5-year term for fixed, quoted I should say, but I don't recommend that right now. You're way better off to take a 1 or a 2-year term, which is what I was referencing, or a variable. So 5-year fixed today, maybe 5.5 if dependent on the down payment. Some conditions apply, but a lot of lenders are over 6%. So you're way better off to take a 1 or a 2-year term with the intention of getting perhaps a 5-year one that expires, because in 12 to 18 months, we're going to see rates coming down. So you take a 1-year term just for the short term, and then you take your lower rate when you refinance. I mean, the whole real estate market's been an absolute roller coaster this year. We went from, record-breaking prices to the biggest slowdown since the financial crisis of 2008. I've had an enormous amount of inquiries pertaining to the Bank of Canada's recent meeting where they lowered the rates by 50 basis points, which is 0.5%. Now, to be clear, I'm referencing the overnight lending rate. Lenders traditionally increase the overnight lending rate by 1.5 to 1.8%, sometimes higher, and then they call it prime rate. So there are correlations with the fixed and variable rates or fluctuating rates, but based on the economy, but they're not directly connected.
So looking down south, the U.S. Fed just increased their rates by another 0.75%. Isn't that right?
Yes, Azim, that's correct. They just increased the rate to 3.75, and that is the same overnight lending rate as we have in Canada. Now, in the States, they are expecting the rates to go about another 1% higher, peaking at 4.75. We're not expected to go that high, maybe a half point, 0.25% more in Canada. Looking at the graph, which is kind of funny because I got it the day before the increase. That's why it's reading 3%, not 3.75. But look at how much of a strong incline that is done in comparison to other tightened financial cycles. To be clear, again, this is America, not Canada. So, it appears the government in the States is taking inflation very, very seriously. High inflation can be absolutely devastating over a long period of time, especially those living on a fixed income. So as of today, again, both of our governments are sitting tied at 3.75. Many economists, people much smarter than me and Azim, expect another increase in the lending rate, as mentioned earlier, but it's very minimal. They don't see it going much higher than half a point before things stabilize and then start to drop. We're just going to have to wait and see each one of these increases, how much of an impact it has on the inflationary challenges that we presently have. Now, looking at the next graph, Bank of Canada hikes less than expected. A lot of people did think that we're going to go up 0.75, myself included. This graph, going back to 06, shows basically where the rates, have gone. They dropped them substantially when the recession kicked in to be able to boost the economy. So we can expect the same thing's going to happen probably next year.
So what's driving the rates up now then?
Well, we've seen substantial increases significantly from their lows during COVID. In spring of 2021, some clients were even able to get 1.69% on a 5-year fixed. Prime at the time was, 2.45%. So getting a 1% discount would have you less than 1.5%. These rates are incredible. They're not going to last. As the saying goes, all good things come to an end. Fixed rates are dictated by the bond yield. As of last week, the bond yield had gone up to 3.71%. So the graph here now presented to you shows the bond rate over the last 2 years. These are all the fluctuations we've seen since, basically 2 years ago, since September 20.
So Jesse, obviously over the last short period, we've been seeing a lot of fluctuations, almost like rapid fire increases in interest rates, which is not common, whether it's decreases or increases. I mean, how often does the Bank of Canada meet to review these overnight lending rates and make changes?
So the Bank of Canada traditionally meets every 6 weeks, but if there's an emergency, they can bump that up and call an emergency meeting. So to be clear, banks dictate their prime rate off the overnight lending rate, which comes from the Bank of Canada.
So here's a question that I get all the time. In fact, just at a social gathering last night, I was asked, historically, what's better, variable or fixed rates?
Well, historically speaking, variable without a question is the better way to go. Now, the problem is a lot of people have trouble sleeping at night, not knowing what the mortgage payment's going to be the next month. If you're one of those people, then, go with a fixed. But if you want to be ahead financially, variable is definitely a better way to go. Now, looking at this graph that we borrowed from our friends at REW, this shows fixed in black and variable rate mortgages going back 10 years. And if you look here, there's only a tiny little portion, tiny little segment where the fixed rate was lower than the variable. Otherwise, it's always variable is a better way to go.
So if someone's in the market to buy in the next 6 months, what would you recommend for them?
First off, make sure you have a proper mortgage qualification in play where they've thoroughly reviewed your applications, your credit, and your documents. You then want to have the mortgage broker or lender ensure that you have a rate hold in place. So if you're able to lock in a rate today at say 5.29, you don't write your offer until January. Well, what if the rates are 6%, 7% for that brief period of time? You're stuck paying the higher rate. Whereas if you have a rate hold, it locks you in place. There's no cost for any of this. And you're protected getting the lower rate. If the rates go down, you're not binded in contract to take the rate hold. You get to take advantage of whatever the best rates are at the time. So again, I would be definitely looking at 1 or 2 year terms or a variable. When the recession kicks in, as mentioned earlier, those who take 5-year fixed rates today are going to be kicking themselves because the rates will decline, mark my words.
So how bad are qualifying rates these days? And, can you explain kind of what qualifying rates are?
Yeah, that's a double-edged sword. So the rates are higher and it's causing prices to drop a little bit. But with a higher rate, that also includes your qualifying rate. So the qualifying rate is what the government introduced in 2017 is the stress test. So you might only be getting, say, 5.5 on your mortgage rate. They want to know that you can afford a 2% higher rate or whatnot. I think it's a great idea. I've actually been doing this for 17 years with clients, just letting them know, not so much forced. Hey, if the rates might go up 2 or 3% in 5 years, it's not common, but it's possible. Can you afford that? Because if you can't, we have a problem. So the current qualifying rate sitting around 7.5%, like that's private lending realm. That's really high. So the problem is it makes it very difficult to qualify for. So, with time this will drop, but for now we're a little bit stuck. Now, how do you get around that? It's a question I get a lot. You can get a cosigner, cosigner, mom, dad, brother, sister, whatever, generally has to be a family member who can help you qualify to get you a bit higher if that's hurting you. Just make sure that you don't overdo it, because what if the rates actually go up to that point and you're stuck paying the bill? So be careful.
Yeah, this is all important stuff because, with our clients, our buyer clients, the first thing we look at with them is what they qualify for. We all have it in our heads what we want, where we want to live, how much we want to spend. But if you haven't visited your mortgage broker, if you haven't talked to your bank, you don't know what your spending limit is, and you're just kind of guessing. And that really helps sometimes lower expectations, sometimes increase expectations, but it really sets the tone. And so, yeah, definitely first step you should do when you're entering the market to buy is talk to your mortgage brokers. Jesse, kind of to sum it up, have we hit the peak in interest rates, do you think?
Yeah, it feels like it. We might go 0.25, 0.5 higher in Canada. I think it's going to go higher in the States, but in Canada, I don't think we're going to go much more. Who knows what happens with the war in Ukraine and all of these other factors that can change things, but I'd say we're pretty close to the peak. To continue on to our last point, as what you were saying, there's no harm. If you're remotely considering doing anything in real estate in the next 6 months, definitely talk to your mortgage broker or your bank or us, because there's no harm. It's totally free just to do the application, have everything looked at, get your docs verified. It's an awesome free exercise that I think everyone should be doing it, just so they know how to take advantage of the market if something comes up.
Yeah, and even if you're looking to buy beyond 6 months from now, a year or 2 years from now, you're saving up, you're looking to buy a pre-sale that's not going to be completed for another few years, I would do what's called your own stress test. Look at what rates are now, add a few points on top. This is what the government implemented so many years ago. We've all been complaining about it because money was cheap. We're like, why are they looking at what we can afford when the rate is 5 or 6% when rates are 2%? But, we're now really seeing what the government's foresight was there. We'll give them a plus for that. And, we can use those same measures in our own life if you're looking to buy in the future. If you can't get a rate hold beyond 6 months, well, just try to figure it out yourself. Maybe have your expectations a little lower. And if rates do fall in the future, like we hope they will, well, you'll have a nice surprise. So let's turn the page and look at October sales data. There's a lot of interesting stuff here. Inflation and rising interest rates have definitely been top of mind for most people. There has been increasing inventory, and this has all led to gradually receding prices, especially from the high that we saw in the springtime. That said, though, the overall stats, while they are down year to year over year, we're starting to see some changes over the last couple months, which are quite surprising. And it's hard to sort of take this into account if you look at what you're feeling out there, if you've been trying to buy or sell, what you're hearing on the news, versus looking at these stats that we're going to talk about right now. And I think what savvy investors do is they don't necessarily listen to all the noise out there, and they really look at the numbers. And those numbers are starting to shift a little bit. If we look at home sales by volume across Metro Vancouver, they were down 45.5% in October year over year. But they're up 12.8% since September. So that's an interesting one. Overall, sales are down 33% over the October tenure average. That's the average of looking at what sales are every October over the last 10 years. Now, I talked a bit about inventory. There was just over 4,000 new listings in Metro Vancouver in October. That's a 0.4% decrease year over year and a 4.6% decrease from the previous month. So here's something interesting again. We keep hearing about increasing inventory, but when you look at the stats, there's actually a slight decrease from last month. And, that may be setting a trend for what we're going to see in the future. Total listings overall, that previous number was new listings, but total listings overall last month were 9,800. That's a 22.6% increase year over year, but just a 1.2% decrease from September. So again, sort of follows the trend I'm talking about, where we may actually either be seeing a little dip or the trend starting to change.
Well spoken. One thing to quickly add on that, though, we're basing these numbers off last year, okay? Well, last year was year 2 of COVID. The year before that was year 1 of COVID. Very weird years that are anomalies. They're not consistent from what we might have seen in the past. And we've had an inventory issue for, I believe, like 3 years now. So to say inventory's up, well, from what, right? Yeah, it's up, but it was from record lows and it's up tiny little bit. So it's really got to come up. We almost need to run these numbers to say where are they at in comparison to 5 years ago instead of last year, just because the last couple of years of COVID were just a disaster for inventory. So yes, we have slight increases, and the pace of sales has declined substantially. But Azim, what do you think, what does that mean for buyers and sellers in your opinion?
Yeah, so right now, if we look at market conditions right now, what buyers can do is really take advantage of the slowdown in the pace of sales and take the time to do their due diligence. Get an inspection in there. Look at the stratadocs thoroughly. If you're concerned, if you're looking at, let's say, a stratified unit that has a lot of issues, but you think might be a good investment, well, maybe get an accountant to look at it. Get a lawyer to look at it. Spend a little extra time really, really diving deep into these properties because you have that as an advantage. That's on the buy side. On the listing side, while sellers obviously want this rapid fire process, get your home on the market, sell within a week, etc., I think you can also sort of take a bit of time to making sure your home is exactly the way you want to show it. Take a little bit of stress off, understand that it's going to take maybe 30 days, maybe 60 days to sell your home. It's not going to sell in a week, but use that to your advantage.
So Azim, can you clarify to our listeners or watchers, are we in a balanced market? Are we in a seller's market? Are we in a buyer's market?
Yeah, so that, again, going back to what I said at the top, you could gauge that sort of on the temperature you feel just by being out there, but how it's actually governed is the ratio called the sales to active ratio. How many units, how many homes are selling versus the number of listings that's active on the market. So traditionally, a buyer's market is when that sales to active ratio is at 12% or below. And a seller's market is when it's at 20% or above. And anything in between that 12 and 20% is what we call the balanced market. So overall in October, the sales to active ratio was at 19.3%. And remember, I'll repeat those numbers I said earlier. 20% and above seller's market, 12% and below buyer's market. So that was 19.3% overall. So that kind of tells you that the stats are saying something different from what we're all hearing out there, what we all feel out there. When we break that down and we look more precisely in the detached market, the sales to active ratio was 14.3%. So fairly balanced, sort of leaning towards a buyer's market for sure. But in townhomes, it's at 21.6% and condos 23.2%. That's well into a seller's market still. So again, these numbers show you something very different from what you might be hearing out in the media.
So to be clear, these numbers are affected by the lack of inventory. We're in the seller's market in 2 of the 3 categories, and we really probably shouldn't be, but we just don't have enough on the market. People are buying what's available, and that's what's causing these prices to be higher. If we had a more healthy amount of inventory, we'd be in a balanced buyer's market across the board. Now, Azim, can you add a little bit of context for our listeners or watchers, or both? What is the benchmark price for these property classes for Metro Vancouver?
Yeah, totally. So just to clarify too, the benchmark price is sort of the average price. That's the terminology we use. So in October, across Metro Vancouver and across all of the subclasses of residential property, benchmark price hit $1.1489 million. That's $1,148,900. That's a 2.1% increase year over year. So something we were mentioning even in our last podcast is when you kind of skip these blips in the market like what we saw in March, year over year, the Vancouver market generally has been increasing. That said, it's 0.6% down from September, so a little bit down, and a whopping 9.2% decrease from 6 months ago, from the springtime. So, that's what really people are looking at is what was the high at, what's it at now? Again, you kind of have to look at what it was like over the last year. And of course, if you're looking at real estate as a long-term investment, what it's at year over year. Now, if we break that down a bit, again, into detached, the benchmark price was $1.892 million. That's up 1.6% year over year, down 0.7% from September. Townhomes, or attached as we like to call them, $1,043,600. Again, up 7.1% year over year, and down just slightly 0.5% from September. And finally, in condos, apartments, the benchmark price was $727,000, up 5.1% year over year, down 0.2% from September. So again, just looking at that, big gains over the last year, slight decrease month over month, but we could be seeing a change in the trends. So in the final analysis, what I would say is, again, try, especially savvy investors know this, try to wade through the noise, try to filter out a lot of that noise. You could look at the market in a microscope and look what's happening over the last few months and kind of think, okay, is this going to continue to drop? But real estate isn't a liquid asset class. It's something that takes long time to sell, long time to buy. You tend to hold on to it for some period of time. So you don't treat it like the stock market, which is going up and down. And in that sense, I highly suggest you look at what the trends are sort of over the long term. It's very hard to take that guidance when we have a year like this, when we had this spring where prices surged, where we have all these crazy interest rates. But my vote is for the long term view on things.
Final analysis and some personal thoughts. What is the best thing to do right now? If you're considering upgrading your home, now is an absolutely fantastic time to do that. You can, yes, prices are down, so you might lose 10% on the house versus 6 months ago, but you're going to get 10% on the higher valued property. So it's a win-win situation. Further hikes are kind of factored into the market. In my opinion, I don't see it declining much further, maybe a tiny little bit. Inventory is slightly increasing. I mean, now's a really good time to buy. If you wait 6 months and try to chase this bottom that might be this month, maybe you might save a few bucks, but those who chase the bottom rarely actually hit it because you don't know until you've already passed it. So there's lots of other things you can look at too. Pre-sales are very, very good option. Something that's not going to be completing for 2, 3, or 4 years because, of course, we'll be long out of our financial turmoil by that point. So other great things to consider at this point.
So we're going to play a little game with you guys now. And we'll probably bring this game back every few months or every time there's a big shift in the market. We're going to call it buying now versus 6 months ago. So we're really going to compare what it would be like to buy your average home with, the current interest rates now, current prices versus what it would be like, 6 months ago. So Jesse, if you bought an average Vancouver condo 6 months ago, back in April, when prices were really high, This would have cost you, according to the stats, $857,000 on average. Your interest rate would have been about 1.7%. That's prime minus 1. Versus now, if you bought that same condo, you'd be paying approximately $776,000, and your rate would be 4.95%. So to me, it sounds like, you'd already be up $80,000.
Yes, definitely. If you buy today versus 6 months ago, you'd definitely be winning that competition if that was you versus me. Now, to be fair, we need to keep in mind that the difference of interest rates has an impact. So assuming you bought now and I bought 6 months ago, if we both put 10% down, took a 30-year amortization, apples to apples comparison, my mortgage in that argument, using the average Vancouver condo, would be $771,000 and change. Basically the same amount as your purchase price. The difference in interest, though, you're going to be paying, over $2,000 a month higher in interest. But over 6 months, that's going to be about $12,500. So taking that number off $80,000, Azim is still richer than Jesse by $67,000. So, brother, you win this round. I will be back.
So let's talk about the foreign buyer ban that we've been hearing about. And right off the top, that title sounds a bit intimidating. Can it actually be true? It is, in fact, true. As of January 1st of this next year, 2023, there is a total foreign buyer ban coming out on property in Canada. Is this going to help? Is it a little too late? In my opinion, it is, I believe. I mean, the federal government has tried so many different ways, including the provincial governments too, to curb the ever-increasing real estate prices in Canada. And a lot of people think that a big cause is foreign buyers. But is it really? In my opinion, they make up such a small percentage of the market. We have to think about what we perceive as a foreign buyer, whether it's people of certain ethnicities, backgrounds, coming from certain countries or whatever, or what is actually classified as a foreign buyer. If you have a Canadian citizenship or a permanent resident card, you are a local buyer. If you do not, no matter where you come from, you're a foreign buyer. So this is one way, you got to give the federal government credit for trying something. But again, as I said, it's a little too late in my opinion. Should they have done this? Probably 20 years ago or something to that effect, and start bringing this in slowly over time. I don't know if it's going to do much. Jesse, what do you think?
Well, you can't really technically bring in a foreign buyer ban over time, but what you can do is you can bring in tax, which is what they did, but they only did it very recently. And the 25% was not affected. It did not affect a lot of people. A lot of people were looking to invest in Vancouver, get out of their respective countries for various reasons. So, the 25% wasn't enough of an impact for them. But that's a small, that's a small group. So realistically, this should have been in a long time ago. One of the things I don't like is it's affecting our biggest trading partner. So the US, if you're an American citizen, you want to buy in Canada, you can't. You cannot. You're completely cut out. So I'm very curious to see what, if any, positive outcome comes from this foreign buyer ban. So interesting stuff. We will cover more of that in the next episode. So, okay, that is all for this episode. Thank you so much for listening or watching. Don't forget, please pick up a copy of my best-selling book on Amazon, Rockstar Real Estate Investing. If you have any questions, we are here for you at any point in time.
Yeah, like Jesse said, have any questions at all, our information is in the description below. Remember to like and subscribe so you can keep up to date on all our future podcasts. And if you are currently a realtor, not happy with your brokerage, or you're looking to join the industry as a realtor, definitely hit us up. We'd love to chat with you about EXP and the collaborative movement that is our brokerage, the amazing things they're doing, how we can help build your practice, and all the other benefits that EXP comes with, which is, by the way, one of the fastest growing brokerages in the world. As I mentioned before, if you're looking to buy or sell property, again, definitely contact us. We'd love to talk to you, whether you just want to get a home evaluation, whether you're new to the market, whatever it is, definitely hit us up. Thank you again. We'll see you at the next podcast.